All right, hey everyone. Today we have two of my favorite people, my dad and Michael, here to talk about the tax implications of buying a home. I'm a buyer's agent here in the Keri Shull team, and I'll let you guys introduce yourself.
I'm Mike Crichton. I'm CPA. I work for Burdette, Smith & Bish here with Charlie. I've been working here for 8 years. I focus on corporate and individual tax planning and preparation. I also do some financial reporting work.
And I'm Charlie Bish, and I've been doing this for about 40 years and trying to keep both Michael and my daughter straight. Tough job.
Yeah, so what's the last joke you're allowed? So we're going to start off with, there's a lot of buzz around the new tax bill. So kind of going to have them give you a quick overview of the implications that has on purchasing a home. And a lot of my clients are asking me, what is this bill? How is it going to affect what I can deduct and all that good stuff?
Yeah, so the new tax bill will go into effect January 1st, 2018. And the biggest change as far as for potential homeowners and current homeowners is the increase in the standard deduction. The standard deduction increased for single filers to $12,000, and for married filing joint filers $24,000. So if your real estate taxes and your mortgage interest that you pay when you're a homeowner, if you're married and filing jointly, the first $24,000, anything over that is deductible, and that includes your charitable donations as well, and then it's $12,000 for single filers.
One of the other major changes was the SALT, the state and local tax limitation of $10,000 to $10,000, and that will affect a lot of people in our Washington, D.C., Maryland area, just because we're in a somewhat high real estate and income tax situation. So that'll probably be one of the things we have to kind of watch for.
And one thing that the new bill kept was the exclusion on the gain on the sale of your home. So as long as if you're a homeowner and you've owned the home for if you've lived in the home for 2 years out of a 5-year period, your gain is excluded for up to $250,000 for single filers and $500,000 for married filing joint filers. That was remained. So that's a benefit.
Yeah, and that's helpful for folks that own homes currently and are expanding their family, need a bigger home. Now you can basically sell that home that's greatly appreciated in the Arlington area and not have to pay tax. So that's helpful.
Do you want to touch on the cap of $750,000 versus $1 million?
Yeah. So with the change, old law, the loan was the $1 million loan was what you could deduct. Now it's the threshold's gone down to $750,000. So and that's you're grandfathered in if you're current, but if you're a current homeowner, but if you are now looking to buy a home, the $750,000 loan, not what you pay for the home, but what your loan is, that is the threshold. So anything higher than that, your interest would be limited.
Capped, right? So if you bought a home for $1.5 million and had $1 million mortgage on that home, $250,000 of that mortgage would not be subject to interest deductibility. So on a 4% loan, that would be a change of around $10,000 annually for people that were under the old law buying a new home, and now under the old law buying a home versus the new law.
And they're still hashing out a lot of stuff, so we'll keep posted on really what happens.
I want to talk about how rentals aren't affected by the limitation.
Right. The limitation is for principal residents. If you have a rental property, there is no threshold. It's an investment property. The interest is deductible, fully deductible. There's no threshold, no cap.
And second
for rental, but for a second home, if you have a primary residence and then you want to buy a second home that's not an investment property, that's not rented, one of the changes is now that interest is no longer deductible.
Okay. So this kind of segues into the difference in taxes with the investment property versus your primary residence? Or is there other stuff that you could tell people out there if they're thinking about buying an investment property in addition to their primary residence, what that affects their taxes and how it does?
Yeah, so kind of like I was saying, the investment property is treated differently. So there's no cap the loan, and your taxes and your interest are deductible, as well as all the other rental expenses that you have. There's no cap on the state and local because those are treated under different rules than the primary residence, which is capped. The state and local taxes, your real estate, personal property, are capped now at $10,000.
Okay, cool. And so a lot of people out there are also renting and deciding between renting versus buying. Can you explain the benefits of buying versus renting from a tax perspective? Because I think a lot of people don't realize that benefit, and also about the monthly gains versus not just at the end of the year.
Sure. So the biggest thing, advantage I would say for buying a home as opposed to renting is the building of the equity into the home. So when you one day sell the home, you're bringing down what your loan is. You're increasing your equity, and then with the exclusion still, passed under the current law, you essentially could be tax free depending on what your gain is. As far as the monthly difference between renting and buying. Charlie, you want
Yeah, sure. Well, what happens there is what a lot of people don't realize is that when you buy a home and you're going to have additional deductions above and beyond the standard deduction, you can actually change your withholding with your employer at the time you buy your home. And what that allows is every month or every pay period, you're going to get more money into your paycheck. Rather than having to wait till the end of the year to realize that benefit. So what that does is help. Oftentimes when you first start to budget the purchase of a new home, the mortgage payment is going to be higher than what you're used to paying as a rent. But by changing your withholding, you can basically enjoy a smaller deficit each month than you would have ordinarily waited, and that kind of helps the cash flow as you move forward.
Yeah, and paying rent, there's no tax benefit to paying rent. But when you're a homeowner, like we talked about with, your mortgage interest is deductible, your real estate taxes are deductible, even with the increased standard deduction. One thing to think about is when you're a homeowner, you're more likely to itemize your deduction as opposed to taking the standard deduction. So sometimes, your charitable contributions, cash you donate to your church or property you donate, they're more likely to be deductible if you're a homeowner rather than renting.
Right. And what we may find in the real estate market is you may find that rentals become more attractive because people will want to buy rental properties to rent them to folks because they may not be able to afford, given the limitations, they may not be able to afford things right away. So renting temporarily will be helpful. So those folks that can afford to buy rental properties may actually find that that's a better investment than even.
Mm-hmm. Great. I think we have some questions coming in. What are the effects for self-employed business owners and 1099 people in general, and specifically for real estate agents? We just touch on, the tax differences between those.
Let's see. So what are the effects of self-business owners, and thank you for enlarging that. 1099 people in general, and specifically real estate agents. I don't know that there's really a lot that changed for that. I mean, if you're speaking of simply the actual business of being a real estate agent, your expenses that you incur are going to be fully deductible against your income. The
rates are lower.
The rates are lower, right? The overall rates are going to be better, and I think that the pass-through deduction that the second question addresses, we're still fleshing that out. We don't know exactly where that.
The question, let me say the question because people don't know.
Oh,
it says, does the pass-through deduction apply to income properties?
Right, and essentially pass-through entities do enjoy a 20% deduction. We're still sort of figuring out how that's going to be worked out. But the thing to keep in mind for real estate agents, for instance, you're considered a personal service, just like CPAs and lawyers and so forth. Those are excluded from the pass-through deduction. So, but if you have a rental business where you have rental properties, that would not be considered personal service, and very well may be allowed to enjoy the pass-through deduction. There are other limitations on rental properties relating to the passive income rules, which is a different situation as well.
And the rental property, if you've purchased in the name of the homeowner, it's not affected at all by the pass-through deduction that was part of the new tax bill. Only if, correct me if I'm wrong, only if a separate entity was set up, then it potentially could be affected by the pass-through deduction. But they're still ironing things out. And,
right. And the concern there, of course, too, is before you.
So back to question 2. I think that's when we got cut off. Chrissy, do you mind pulling that sheet up again for me? Does the pass-through deduction apply to income properties?
We're talking about whether an entity purchased it or.
Yeah. So for a rental property, an income property, if the individual purchases the property, then it's reported on the individual's return, and the pass-through deduction doesn't affect it. Only if a separate entity was formed, purchased the rental property, would it potentially be subject to the pass-through deduction. And there's still we're still ironing things out with that. But
and the other thing to keep in mind is the passive income rules that rental properties are subjected to.
Another question that came in: does rental income get taxed at the new lower rate?
The rental income will just still be taxed at the ordinary rate, and then with the new tax bill, the ordinary rates, decrease. So that's something to, to think about.
And so all of our clients are covering DC, Maryland, and Virginia. And a lot of times they ask, they're deciding between one or two of those states, and they ask, what are the tax implications? Can you kind of describe, the difference in the states and
Sure.
different types of taxes?
Sure. Virginia has the lowest income tax rate. It's 5.75% over $17,000, I think. So that's the lowest rate. Maryland has the income tax rate, which is I think about I think we have it right here.
It's
about 5.5%. But then Maryland also has local taxes. So depending on what county you live in, you have an additional tax, and I would say it kind of comes out to about 8% total Maryland state and local income tax, and then DC is about 8.95%, which is the top rate for income over $1 million. So, with that said, Virginia is the lowest rate. Now, Virginia is the only state that has personal property taxes, which are deductible, but that's something to consider. Your vehicle, you pay a personal property tax on that, but still, with that said, Virginia is the lowest total tax rate.
Right.
And we have a sheet here that we can post after, kind of laying those out so you have it. It looks like we have another question. Would a seller owe tax if he owns the unit for 2 years or less?
So, if you sell your primary residence, if you have a gain, you could owe tax. If you live there for 2 years, for less than 2 years, if you sell it at a loss, it's not deductible. But if you sell it at a gain, you don't get the exclusion. However, there are increases to basis. So if you bought it, and then you sell it a year later, if you redid your kitchen, it increases your basis and decreasing your gain. Any kind of other, capital improvements is, you'd want to track those. But if you could owe tax if you, so it's something to consider when you're selling your home is, if I live there for at least 2 years in a 5-year period to, get capitalized on that exclusion from from the sale of your home.
And Mike brings up a good point too, is one of the things you really want to do when you purchase a home is maintain really good records of all the improvements that you've made. Because in this area, folks can live in homes for 10, 15 years, and you can, over those years, you've probably done a lot of things to improve it. And if you keep records of that, that will certainly help reduce the gain or potential gain down the road. The other nice thing about living in this area is, especially in Arlington, there's a good chance that you'll have a gain in 2 years, whereas in a lot of places where you purchase homes, you may not enjoy a gain that quickly. So.
And one thing to follow up on that, with a seller owe tax, if there is a gain and you don't get the exclusion, it is a capital gain, taxed at capital gain tax rates, which are lower than ordinary income tax
Assuming
rates.
that you've lived in the home for a year and a day.
Yes.
Yeah.
Okay, are rental properties sold at a loss from the original price taxable?
Well, the loss losses are never taxable. They're helpful. So the answer is that rental properties sold at a loss potentially would be offset your other income. The issue you have to be concerned about or watch there is depreciation. If you've owned the rental property, once you buy a rental property, you depreciate it every year. That depreciation reduces the cost basis, if you will. And essentially what that means, if you bought it for $100,000 and we have depreciation for $5,000 a year and you've depreciated it for 2 years, that would be $10,000. Now your cost for determining a gain or loss is $90,000, not the $100,000 that you bought it for. And the reason for that is that $5,000 of depreciation that you've taken every year helps to offset your ordinary income, your rental loss or your rental income every year that you rent the property. So you can't have it both ways, so that's why it's reduced. That probably confused everybody. Sorry about that. If you have other questions on that, talk to Mike.
Yeah.
Do you have any other questions, Christy?
Nope.
Okay, cool. So it's a lot of information. We'll definitely post the video. Any further questions you have, please let us know. We'll be happy to follow up. They'll be happy to answer them for you directly. Obviously, it's case by case, so a lot of these questions are very specific, but they'd be happy to help you and do that. If you're looking to buy or sell, we're here. The Keri Shull team here is the #1 team in Virginia, and we do business in DC, Maryland, and Virginia, not only in Virginia, and you also have free consulting from a tax consultant if you use us. So thanks for tuning in. Any further questions, let us know. We'll post the sheet and have a great day.